everyone, it's Michael here. Welcome to beautiful Stockholm. We are here in Sweden, and as a result, the appropriate thing to do is to talk about tax planning for Swedish residents. Now, I say this because honestly, it's not really like people would relocate here to come for business purposes. There isn't really good, there's no citizenship by investment, things like that. But it's a great place to live. There's lots of reasons to be here, and there's really high tax. So if you earn wages, the top tax rate is 58%, plus there is social contributions for the employer. I think it's like 31.7% or something. And then there's pension contributions of like 7% or something like that. So quite high overall numbers that you're gonna be giving up out of what it is that you make. And so as a result, you typically wouldn't really, probably want that. You'd like to find out how to save as much money as possible if you're some sort of a business person looking to be resident in Sweden, or you're already resident in Sweden. So what would we do? Well, we'll go through quickly the three main areas that we pay attention to, which are obviously corporate residency, the source of income, and the controlled foreign companies rules. So if you guys aren't familiar, you can go and check out our other videos where we described exactly what each of those things are. So corporate residency in Sweden is actually not horrible to deal with. It's basically any company that's registered in Sweden is a Swedish company. Where they expand on that quite a bit is when you're talking about their income basis, right? And here we have quite a broad definition of permanent establishments. For example, when it comes to royalties being paid out, that can constitute permanent establishments, and so there can be taxation on that basis. So in practice, you get something a little bit similar to the management and control rules that you see somewhere, like UK, etc., but not necessarily, right? So a little bit less, but still pretty encompassing. So in other words, if you run a company from Sweden, if you have a company that's registered in Sweden, you're typically going to be subject to tax in Sweden on that. Now, a few things about that. So just a base Swedish company has a tax rate of like 22, just slightly under 22% more recently. And so as a result, that's, not horrible, right? Again, the worst part is when you stack that with actually taking the income personally. That's where it becomes most painful. Dividends are taxed also, although I mentioned, hey, it's 58% top tax rate. Investment income, which includes dividends, are taxed at 30%. So much better, still not amazing. And in particular, again, if you stack them with the corporate tax rate, then that's where it becomes an issue, right? If you're paying, say, 22% corporately, and then on top of that, you're paying 30% on the distribution, well, that's, less than ideal, right? So, and the third part that we're gonna have to pay the most attention to is going to be the CFC rules, because as with pretty much any time we're doing in any high tax type country, when we're doing tax planning, obviously one of the first things we wanna do is we wanna have a foreign company, right? Some sort of foreign company where we can have the income subjected to lower tax, and then we're gonna do one of two things. We're gonna either try and bring the dividends back at a favorable tax rate, or we're gonna keep the money there and we're gonna take advantage of better write-offs. We're gonna be in a situation where we're gonna get deferral benefits, and in that case, we need to have a low foreign tax rate, right? So again, 21% is not exceptionally high. It's between 21 and 22, I think it's 21.4% is the normal corporate tax rate. So not insane, right? Not like we're talking about something where it's hyper uncompetitive like the former 40% that they had in the US. It's competitive with UK, which is like 19%. Competitive with, Lithuania is 15%. You can kind of look around and see these sorts of things. But overall, still, again, when you stack it, it's not so good. So the best international tax planning strategy is to try and get that down. So what would we do? We'd form a foreign company. And then the key thing that we want is we want actual economic activity taking place in that foreign company or in that foreign country, ideally, or potentially in some other situation where it's at least not in Sweden, okay? And you want to not have a permanent establishment in Sweden. So you can look up the definitions on that. We have a video on permanent establishments. So no permanent establishments in Sweden, foreign registered company with foreign operations. Okay, that's pretty normal from what we're talking about so far. Now, where we get into some complications is where the controlled foreign companies rules come in, and they changed just in late 2018 in response to the EU directive, the anti-tax avoidance directive. So when they brought that in, Sweden has always had, I would say fairly, not always, but so long as they've had the rules, they've had fairly tough rules. They're pretty organized here. They have a nice system of getting things done, which works for you and against you. The bad part about it is, hey, they're good at what they do, and the good part of it is they're kind of clear with it, and it's not ambiguous, it's fairly organized, right? So the way that they've changed it is, first of all, realizing that the thresholds for being a CFC are typically 25%, not 50%. Now the rules are really complicated, so I'm going to try and simplify them for you here. But loosely speaking, recognize if you have a 20% interest either in voting rights or in terms of distribution rights, directly or indirectly, that could be subject to CFC rules, okay? Now, where Sweden is pretty good is that they have a bunch of exemptions to that. Okay, so first of all, it only applies if it's low tax income. Low tax income is when it is less than 55% of the Swedish tax rate. So I think it works out to 11 point something, right? So approximately 11%, you're saying. If it's below 11%, you have issues. That's the first point. However, again, it gets a little bit better because they also have a whitelist. Okay, so the whitelist is quite broad, and it includes typically the EEA countries. Now you have to be careful with this whitelist because it doesn't apply to all income. So for example, they brought in some things where certain, the royalties regimes in certain countries wouldn't apply. The favorable tax regimes that they might have in a place like Malta might not apply, and so on and so forth. So basically they're pretty smart about knowing, okay, Switzerland has this good regime here, so we have an exception that even though it's EEA, under certain cases, this doesn't apply. And hey, Luxembourg, same idea, and so on and so forth. So you need to look at the list. Looking at the list is super important. And you want to pay attention to, like, okay, what is it, am I on that list? If you're on that list, that's good for you because then the low tax threshold doesn't necessarily apply. And there's like 153 countries, so it's pretty broad that we're talking about here. Now, even if that's the case, so if they have one of these exceptions, for example, with Malta, with Switzerland, etc., you can still get away with it if it's operating from a genuine commercial activity, permanent establishment in that country. So for example, let's talk about Sweden, right? A big Swedish company, IKEA or Volvo, right? Let's talk about Volvo. Well, Volvo goes and sets up a plant in some country. They have genuine economic activity there. The income from that plant is not going to be subject to the CFC rules, okay? So that's a really, really big piece that we want to pay attention to, okay? So ideally, what do? You have this foreign company, the foreign company operates abroad, it gets by on one of these, under the white list or genuine economic activity, ideally as much as possible, so you don't want to bring scrutiny to it. If you can, have both, right? That would be great. Next, we really want to make sure in a perfect world that we could take advantage of the participation exemptions. Not necessary, because you'd say, okay, well, I can leave the money there, I don't need to take advantage of the participation exemption. Or, hey, I'm in a position where I can, I'm just going to take the money as dividends and I'm going to pay the tax on the dividends. You'll get a tax credit typically for the foreign taxes paid, if that's the case. The dividends, but it doesn't apply if the dividends are a write-off in the country. So kind of keeping that in mind in terms of how all the rules work out. If you can do that, then great. You're happy with your, 30% plus whatever your corporate tax rate is, and you tried to get your corporate tax rate obviously as close to zero as possible, and off you go. And by the way, the CFC rules apply indirectly, so you can't layer companies in there and make that work for you, unfortunately. So, if you can't, but as usual, right, in a lot of these countries we're talking about this, is you may want to have this held by a local company, and if you own it with a local company, the reason for that is if you can take advantage of the participation exemption, if you can bring it into the country tax-free, then you're in a situation where now you could use that potentially more easily to qualify for loans locally. So, is it worth it? It depends, right? It's a bit of a trade-off on a case-by-case basis. It's not going to save you tax intrinsically, but at least it might not cost you tax. It's harder to plan for, but if you can get away with it, then okay, receive the funds, they're in the country, now it's going to be easier when dealing with banks, etc., to qualify for loans. So it's something to keep in mind when you're doing that. So I think the name of the game here is, in Sweden, more than in most places, foreign genuine economic activity is really important. Ideally, paying attention to the white lists is important. Paying attention to these, getting around any of their specific targeted exemptions on that white list are important. And if you can do that, then you can be in a pretty competitive situation where, at least until you bring the money back, yeah, you're still going to pay 30% tax. 30% tax isn't low, but at least it's not horrible. And so that would be kind of your goal. Now, if you're in a situation where you do have to do something in Sweden, you want to do it via a separate company, or so there's an arm's length distance. You don't want this is the way that we do it. We do profit centers and cost centers. And so you'd have a cost center in Sweden, there's not going to be a lot of profit. You're going to pay out the expenses there, you're going to have anybody who's local there, that's that. Whereas the profit is accumulated somewhere else, and then it turns out later on you're going to go and bring those profits back to yourself, or utilize them, or spend them, or reinvest them, etc. Finally, there is a lot of, the Swedish tax code is super detailed on the subject of the types of income and how they do these calculations. So you need to dive into those. If you want help, you can reach out to us. Typically, investment income has different rules around it than non-investment income. And so be aware of those as well, so that you can hopefully not end up in a situation where you're gonna have any issues. And so if you want more help with that, I know it's kind of long and complex, reach out to us, we'll help you out, and we'll talk to you guys on the next video.